In this day and age, being a bridge lender, is there going to be more need or less need for bridge lenders?
I see more.
Why?
A lot of banks, maybe they've had bad loans on their books and, or they're skeptical or they're just not lending at all based off internal things within their banks, or they're consolidated or selling paper. So instead of them actually originating the loans themselves, they'll just back leverage a private debt fund like ourselves. Now I find that there's been more competition with groups like us coming to market, and the check sizes from a private group that maybe 5-6 years ago would have done a $2 to $10 million loan. Now they're coming more in abundance to do a $15 to $30 million loan because the back leverage and the cost of capital to get there has come down, and there's more abundance of back leverage to get involved. But will that continue? I don't know. I don't know what happens. I don't know how that's going to work politically. I just know that there's a lot of people who are coming to us as a first option that never would have 2-3 years ago.
Welcome back. We're here. We're confronting the impossible. I'm here with a very good friend. Please announce yourself.
Jonnie Haber, Hirschmark Capital. Thank you for having me, Leo.
Nice to meet you, Johnny. Good to have you on the podcast today. Look, let me tell you about the podcast itself, okay? We talk about what makes people tick in the event that they're not facing something that they have ever faced before. And that's important because when you're confronting the impossible, you have to know that there will be uncertainty, okay? And you're a bridge finance lender, right? And you broker those things, correct?
Correct.
So a lot of your clients go through that uncertainty. Tell me an event in your client's, deal that was uncertain and you fixed and confronted that possible. Please.
Sure, yeah. Thank you for having me. I think the nature of bridge financing is fast-paced, uncertainty. People want to try and get certainty of execution in times that are pretty gray. Every single deal we work on typically has some sort of timing issue.
It's short.
Very short timing. 2 weeks, 3 weeks, 4 weeks. They're trying to finance a deal. It could be something that has earnest money on the line and their bank backed out last second because credit committee didn't approve it. It could be because of rent stabilization that's going on in New York City. It could be because construction financing is hard to come across. It could be on the flip side, a deal took too long and they don't have their CO or TCO, and they've been extending with their own bank or lender for a number of years and their rate is just very high. There's no interest reserve and they want to pay down, their loan and cash out some equity to pay off investor. Could be, family disputes. We have many owner-occupied deals that we work on, second, third generation real estate with no debt, and they were trying to cash out to buy out a relative or someone in the business or use that money for alternative SBA loans. So we see it all. I mean, New York, you see so many situations, so many different assets. Obviously here, there's always movement. But yeah, people are definitely coming to us because they're trying to solve something where there's uncertainty.
Tell me about an event that your client had, a specific event that your client had that you helped them through.
There's a development site in Queens. We're on Fund 2 now, but when we launched Fund 1, the first deal that we did in Fund 1 was a development site in Long Island City. It was a $20 million purchase, and the borrower is a developer, very seasoned. He's building a 300-unit project right now in Edgewater, Miami. He's done a number of projects in Long Island City, in Astoria as well. And he was in contract to close on a project development site in which it was a $20 million purchase. 6 weeks before his closing, his lender backed out of the deal. He had about $3 million earnest money deposit, and he needed a 50% loan to value. He needed a $10 million loan. The lender that he was working with basically said, because the rates had gone up at the time, we're not servicing new clients, we're only going to service existing customers. So he had about 5 weeks to figure out what to do. We got involved through actually his equity broker, with somebody who knew one of our attorneys in the office, and called us and said, I'm in this situation. We looked at the deal, we knew the area, we knew what was going on. Basically also to give us comfort on the deal, right across the block, he had a 200-unit new construction rental project that's fully leased up. So we said to ourselves, okay, within 12 months, realistically, he's going to get construction financing. He's putting $10 million of equity into the deal. It's not like a small amount of money. He clearly has the experience. He believes in this project. And we have a clear path to exit within 12 months. So we did the deal. 3 years later, now he's got it leased up. He refied us out with an $80 million construction loan 10 months later. And, that was a situation where the guy, if we didn't have him help him out, you've had to figure out how to appease a bunch of investors.
So why did his lender walk away?
Because at that time, rates, were going up. You remember during the Fed was putting up rates every 2 months or so. It was going up 25 bips, 50 bips. And just lenders are backing out. They're backing out different assets that were more risky, land, office, projects that were not cash flowing. And they just made a credit committee. I mean, I don't know why, but I just see today that a lot of traditional lenders are not actively lending and they're back leveraging other private groups.
Why?
Because if you think about it from an LTV standpoint, if a private lender is giving, let's say, a $10 million loan, he's getting advanced from a bank, typically somewhere between 60 to 70, maybe 80% on whatever that loan is. So if the bank can have a lower leverage point on the asset and not have to deal with the management, the asset management headaches, and they have a private group that's facilitating the entire loan process, then they much more rather would put their money out that way, where they have a trusted partner on the debt side to do it for them. And so at the end of the day, it just comes down to basis.
What area and number do you guys work in? 1 to 10, 1 to 50, 1 to 100?
I say our sweet spot is in the $3 to $30 million space.
Tell me about a $25 million deal. Industrial or multifamily, what assets do you guys focus on?
I mean, we had a $22 million condo inventory loan that we did in Astoria. It's kind of one of these case studies I was referencing earlier where there was a construction lender that was on the project. The guy had a delay on the project. He couldn't get his CO in time. His interest reserve was depleted, so he's coming out of pocket to pay his interest payments. And at the same time also, the property had appreciated in value significantly because the area had gotten, more valuable over the years. And he was in this inflection point whether he renews his existing loan, has to pay more points to extend the loan, do a capital call to figure out how to come up with a year's worth of reserves, and then also have a tough conversation, with people, as opposed to just refinancing the loan that was, I think, at like 12 or 13% at the time, is something around 8%, cash out money. So he was able to pay off an investor, recuperate his interest reserve. And then also he already had 3 units that were in contract. So every single unit that was going to sell was going to pay off the balance. So it was a situation where it's just timing, You can't predict for these situations. No one goes into a project assuming that they're going to have a delay or have to, extend their loan, term. Most of the time they think that I'm going to get in and out without 18 months, 24 months. But if and when that happens, that's oftentimes when we have the relationship, whether it be attorney or mortgage broker, to get involved and help salvage the situation.
How important is timing in your business?
It's very important. I think that at the end of the day, and I think you might agree with me, that the business that we're in a lot of the times is a commodity. It comes down to relationships, and you have to be in the right place at the right time, and you have to have the expertise to execute. People want to work with somebody where they know that at the end of the day, they're not going to play games. They're not trying to figure it out. They're not going to be a guinea pig on their deal. They're going to call you and they say, this guy is good, his nose, his term sheet is real, his money is there. The price is the price, but I know that at the end of the day, the probability of my deal to be executed is 100%. And that just comes down to relationships and being good at what you do.
So talk about disputes. You said that there's litigation involved or pre-litigation or disputes. Tell me about that. Tell me about a case that you had that lending cured.
Yeah, I would say as far as disputes is concerned, I mean, we come across all kinds of deals, but I would say as far as where I've seen at my time in Hirschmark, where there has been bridge financing to resolve disputes has been with owner-occupied real estate.
Tell me about that.
Many times it's been second or third generation real estate that's been within the family. Somebody was in a business and their father or grandfather has an industrial site that they're using for whatever business that they're in. And then 2 or 3 generations later, they inherit the real estate, but somebody's not in the business, and maybe there's a will and estate, and there's all kinds of, I guess you can say, politics from the family, who's owed what or whatever. One person wants to stay involved in the business, one person wants to cash out, and they say don't work with family because it can get ugly, and there's been times that we basically cashed out real estate for somebody within the real estate member of the TIC to pay off someone else and get them out of the transaction, get them out of the real estate ownership. And, that's where, as far as the capacity we're involved. I'm not saying that we're involved as far as like the litigation itself, but I'm saying there was litigious events that occurred with the borrowers in which there was a low leverage deal where we came involved to resolve the dispute.
So tell me a time a deal didn't work out and what happened. You don't qualify everybody, right?
In Texas, I think there's a good example. When I first came to Hirschmark, we were expanding our business geographically, trying to feel out different markets. Florida and Texas, were 2 markets we expanded to. I did, a number of deals in Dallas, Texas. And what I found there was that there were local community banks that effectively were like bridge lenders out there that were working on these special situations. And the way that they underwrote the real estate versus how we underwrote the real estate was very different. I think you could say that there was a lot of high risk involved, as far as their underwriting, and they were just going with a relationship, trying to get deposits, trying to get involved in other aspects of the borrower. What I found was a lot of those banks actually folded or they got acquired or their debt got sold, and you read about it in the Real Deal or whatever today, what's going on. So, we stuck to our principles. We're definitely not a max leverage type of lender or trying to take out, very hairy, risky, borrowers. We typically want to get involved with a deal where, I said, like this cadence I was talking about earlier, where there's a reputable sponsor, there's a reputable piece of real estate, the LTV is decent. We know that there's a clear path to payoff, whether that be sale of the property, bankable refinance, construction takeout, or, if it's low enough leverage, there's a number of different groups out there that like to buy, non-performing loans at par as long as it's at the right basis. So that's where we try to float our into.
What does it take to be a broker in this environment?
A broker or direct lender?
The broker and direct lender.
I think, like you mentioned to me off the air, it's a lot of consistency and putting yourself out there. It's not about who you know, it's about who knows you, being in the right places. I saw an interesting video on LinkedIn the other day, and the guy says, this coffee, if I buy it in the store, it's $3. If I buy it at the hotel, it's $8. If I buy it at the yacht club, it's $20. It's the same coffee, but the price he charges is what he charges because of where he's at, And I think that's ultimately like being a broker, You have to be in the right room with the right people. The service that you provide, a lot of other people can do it, but the connections that you make are unique to you, and you got to position yourself to be there. And I would say that's important. I think it's also important early in your career. Don't think to try and make the most amount of money. Work alongside someone who's very good at what they do and follow step by step their business approach and let them mentor you for 3 to 5 years and learn the business from scratch. And then you're at a point where you can grow with that person, or that person maybe bankrolls you or supports you, and you learn from that way. But I think, as a broker, stop trying to reinvent the wheel. There's a proven method of what works. Obviously, there's iterations of things, technology, AI, that we all adapt on, markets, politics all change. But I think working with good, honest people who will show you the ropes, that's very important.
What's a quality that a direct lender has to have to understand who are the bad borrowers and the good borrowers?
I think you have to really know your streets that you're operating in. I've seen that there's a lot of lenders that, everyone has different underwriting and different risk tolerance. There are groups that don't service their own loans. They write loans, they sell it, CMBS. So it's really just getting a fee. Or there's groups like us that we hold our own paper. So we really have to be very, very
diligent,
in the areas that we're operating. how we're able to do that, or so hyper focused on where we lend is New York City and now Miami. We're working with people on the street. Anybody from the boutique brokerage that's got 2 or 3 guys for retail leasing to a resi broker to the guy in Sheepshead Bay, who's only doing stuff in his backyard. I think we all rely on people that know what they do cold, and through that we're able to say, hey, like, I know you for years. What do you think this is worth? Maybe he knows something about the property that I'm bringing to him. Maybe he had a deal fall apart in the deal I'm bringing to him as a broker, as a retail leasing broker, or sales broker, or office leasing broker, or whatever. And I take that information and I help that determine, is this a good deal or not based off that. And also at the same time, internally, what's my cost of capital? Where's my leverage coming from? And how high can I go on the capital stack? So it's working with people, I would say, that are very niche, and they know the areas cold.
In this day and age, being a bridge lender, is there going to be more need or less need for bridge lenders?
I see more.
Why?
I can't say definitively we'll continue this way, but I think it's more. I think it has to do with what I was saying earlier, was that a lot of banks, maybe they've had bad loans on their books, and or they're skeptical, or they're just not lending at all, based off internal things within their banks, or they're consolidated or selling paper. So instead of them actually originating the loans themselves, they'll just back leverage a private debt fund like ourselves. Now I find that there's been more competition with groups like us coming to market, and the check sizes from a private group that maybe 5-6 years ago would have done a $2 to $10 million loan. Now they're coming more in abundance to do a $15 to $30 million loan, because the back leverage and the cost of capital to get there has come down, and there's more abundance of back leverage to get involved. But will that continue? I don't know. I don't know what happens. I don't know how that's going to work politically. I don't know if people are afraid to take on that risk. I don't know if it'll continue. I just know that there's a lot of people who are coming to us as a first option that never would have 2-3 years ago. I mean, I know there's a lot less red tape when it comes for a loan. A bank is underwriting something based off DSCR, pro forma, and cash flow. They're underwriting the borrower, his credit score, his reputation, historically. But for us, coming from the background where we own, invest, and have sold hundreds of millions of dollars of real estate, for the past 15 years, when we get involved in a deal, we typically know the value and everything that's happening from our own transactions that we've done, or stuff that we have that was money down the street, and seeing how it's performing. So as a result of which, we're able to use that and tap into that information to give a certainty of close to whoever is on the other side. And, borrowers typically, everyone's different, but at the end of the day, if there's a syndicator who has money that he doesn't put out, he loses an investor, or he loses, or he has to figure out, to place that money, he's got incentive to work very quickly with the TOE, and that's oftentimes what we're servicing.
So last question.
Yeah.
What do we have to look forward to in New York City and in Miami in the coming 3 years?
I focus more on New York, so I can't speak to Miami. I just know Miami organically because my wife's from Aventura. So the past 4 years, I've been just seeing everything that's happening there. Crazy amount of construction, crazy amount of job relocation, a crazy amount of just Jewish schools have opened, and they're already like full, before they even have day one. So there's obviously a lot of migration, and I think it's a solid, lifestyle to be living. So the population is there to stay. People say that, people go and come back. I found singles go and they come back, but families, are there and they're staying. They're moving from the Upper East Side. I live in the Upper East Side, now in the Five Towns, but I know a number of young families that moved from the Upper East Side. They moved to Bay Harbor Island. They moved to, Aventura, Hollywood, because they think that it's a good place to be, as far as raising a family. It's conducive to that. How New York is going to be in the future as far as multifamily and construction development, I think what's interesting, Bob Knackel said a week ago on a conference that he was at, he was saying the Mamdani effect has shown within his transactions that there's been an uptick in development site sales because the investors have been putting their money into development sites, whether it be affordable housing or condos, who maybe in the past 5, 7, 8, 10 years ago would have been investing in Lower East Side, East Village, Upper East Side, walk-ups doing value add play and deregulating, rent stabilized apartments and making the free market. But that business model is basically not possible today. And there are value add investors who are still looking to be in New York City because they believe in New York City. So they're investing in development. Also, I would say that people who are in the value add space, what I found is that there's a tremendous amount of people my age, second or third generation real estate families that have excitement. They're willing to roll up their sleeves. They already have existing portfolio and experience of real estate to fall back on, so they know what the market is. And they have a tremendous amount of cash that's been waiting for this opportunity to buy things at a decent basis. When I started my career in investment sales, as Eastern Consolidated, I remember a Lower East Side 25-footer would sell for like a 3.8 cap would be marketed at, right? And that was like a high cap rate to put something out to market, Sometimes things would trade as low as like 3 caps for value add. So, those buildings were trading at $800,000, $900,000 a foot. Today, the same buildings, you can get at a 7 cap, maybe even an 8 cap at $400 to $600 a foot in the same area, right by Essex Crossings or Katz Deli, or, where there's new developments happening. So I think that long term, New York will obviously succeed. I think what people need to figure out is how do you carry your cost of capital for the next 2 to 5 years? Because that's uncertain. But if you can get over that hump and you can be at a decent enough basis and you have enough cash to weather the storm, you'll probably be pretty successful. And we'll all look at those guys 10 years from now and say they're geniuses,
But they're surviving.
I think to survive in New York, you need to be able to come to the table with a tremendous amount of cash where that weeds out a lot of competition. They're getting a better basis, but they're also coming to the table with a lot of money.
It was very nice to meet you.
Thank you
very
for
nice
having
to
me.
talk to you.
Yeah.
Very, very insightful. And until next time, I'm confronting the impossible.
Thank you, Leo.